Hey guys, what's up? How's it going? Welcome back for another update on the channel. Today's video, we're going to be doing an update on the margin investing case study. And if you guys missed the previous update, I did combine the previous update with my last portfolio update on the channel. So that was like an all-in-one video. So check that one out if you guys want. That was the third update in the series. And in today's video, I think the last video we talked about was interest rates and how interest rates matter with your portfolio and why it's important to basically beat your interest rate. That's the sustainability of margin investing long term. Traditionally, margin accounts are kind of more made to do like short-term trades. We're kind of taking a different approach on how we can leverage long-term investing as well as taking advantage of upswings in the market. So in today's video, we're going to be focusing mostly on why we use covered call ETFs to invest in our margin account. So let's do a quick little update on the margin account itself. Let's do a quick little return here. So our margin account here, $431 is the actual cash value we have in that account. And that's going to be the $50 we initially deposited, as well as any dividends or stock sales that we've made. So we have our margin account linked to our TFSA on Wealthsimple. Here's some quick little information here. So we have $7,102 currently used in margin, and my buffer is basically, my cap is 7% of my TFSA. My TFSA is $193,000 at the time of doing this video. So give or take, that's going to be around $13-ish thousand. That's my cap. And basically what I've done, if you guys aren't following, didn't watch the previous videos, definitely check them out if you guys want to know how I've been doing it. But basically every single day when markets drop, I buy. And if markets go up, I sell a little bit here and there to trim some of the gains, depending on what's going on, or if certain things are going on, or if I'm getting close to like my margin cap. So we've done a couple trims, and in the early stages of growing the account, we've done more trims just to kind of get used to it, just to kind of handle things and to take some gains. And again, the idea with this portfolio is we're leveraging the dividends to beat the interest, so we're getting our returns from dividends. That's going to be paying down the debt and the margin, as well as capital gains. And today the market is down quite a bit. We can see it's a bit of a red day, so this would be a great day to buy stocks. And this I buy some stocks this morning, and I'll take a peek at the end of the day, and I'll probably buy some more shares depending on what's down. And everything in our portfolio is down right now, but this is just today's price. But you can see the all-time return, we're actually up for most of these funds, and the portfolio overall all-time is up about $386, 772%, or I guess 750% now, since the market has gone down a little bit today. I think yesterday we were up about 850%. So the margin account has been pretty consistently growing. We can click on this tab here and we can see more details about the account. So again, $428 in actual cash value. That's how much money we've made so far, minus the $50. All-time return is $378, so that's our total return we made. Of that return, $106 is unrealized return. So this would be our holdings that we currently hold. So we're up $106 with those funds. Again, total return here, we'll skip that. Realized return is going to be the sales from the stocks we've had. So we've been trimming off some sales here and there just to kind of reduce the debt, just to get in the habit of doing so. And whenever I feel like I'm getting close to my cap, or I feel like I'm uncomfortable, I will trim a little bit. And we've kind of been pushing that to be a little bit later as the account grows and whatnot. But we do want to kind of, like, as I get close to things and we see some gains, take off some capital growth. And one of the things I have been doing is you can also just trim individual holdings too. So if I was to look at my portfolio and be like, hey, I've also been using trimming as a tool to rebalance. So if I'm like, hey, you know what, I have too much HDIV, and HDIV is up like 5% or 6% like it was yesterday, I could sell some of it to either invest into a different stock or just to wait until things drop. Same thing with something like VDY. If VDY goes up, I sold some VFV recently because it was up quite a bit, so we took some capital gains from that. So you don't have to sell everything inside your portfolio. You can just trim your big positions on gains if you want, and it's a great tool, a great way to rebalance your portfolio. I've kind of learned that. For example, like I had a lot of extra shares in HHIS, and it was up a little bit. I think it was up like 3 or 4%. So we sold some of the shares. It kind of brought things down, and we can rebalance our portfolio that way. So that's kind of what I've also been using trimming in a way to do that, because it's very easy to kind of mess up your allocation, especially when HHIS is down like 2.56%. You want to buy it, right? So sometimes in the short term, your allocations can get a little bit skewed or messed up, but we can use trimming when the price goes up to help balance that out. So I've been kind of doing that as well. Going back inside the gains here, so $225 in sales. This again is us selling our stocks, and the biggest ones are obviously going to be the VFV and VDY and XEI, because those are our traditional funds. VFV is going to be our biggest growth fund, and VDY is our growth/dividend fund. So, those are the ones we want to sell for tax reasons, but also just because they're going to get the most growth. And I'm sure you guys can see my cats kind of running around the background there. They're chasing each other. It's been a bit of a hectic morning. But yeah, you'll see them running around. Sorry about that. Anyways, dividends earned, we have about $82 in total dividends, and you can see the funds obviously. So the covered call funds, and this leads into what we're going to talk about today in today's video, is why we use the covered call funds. And the biggest reason why we use them is to increase the yield. We can increase the yield, hold more growth inside the portfolio, and beat that interest rate. And you can see with the $82 in dividends that we've earned so far, HHIS, HDIV, CDAY, some of these bigger funds are paying us the bulk of the dividends are coming from the covered call ETFs to help offset that interest. So that's the main thing. That's the thing we're going to talk about in today's video. So we're going to head over to track my dividends to basically give you guys a bit of a clearer picture here to help you understand the allocations of the margin account and why we're using covered call ETFs. So specifically, we wanted to have a nice balanced portfolio here, and we have about 70% of the portfolio in growth/dividend stocks, right? Where our goal is about 30% VFB. You can see right here we're at about 24%. For our Canadian dividend stocks, we want to have about 20% XEI and about 20% VDY. So we're about 14%. So we're a little bit off there in terms of that allocation. And then we want to have about 30% in covered calls. So we kind of have again, the vast majority of the margin account is in growth. And by having a little income sleeve, it helps us beat the interest, because again, my goal is around that 6% dividend yield, give or take, but obviously it fluctuates quite a bit. But in our interest, I don't know if I talked about this in today's video, but if we go over to the margin account here, I'm just going to click here and show you guys, our interest is actually 4.45%. So if we can use our covered call ETFs to basically beat the interest and get a little bit extra, we're getting gains from the short term as well as the long term from those dividends, right? And that's helping pay off the debt. So worst case scenario, if we're in a long-term market or a downward market or something happens, and we do intend on holding this portfolio over the long term and having a passive approach, at least we can feel good about the dividends paying the interest. We don't have to worry about it. We're paying it, plus we're making extra money. And every single time we get a dividend, which are staggered across the month, we reduce our debt, we're paying it off. Feels good, right? Psychologically, it's a huge benefit, keeps you motivated. It's just like when I first started investing, I focused on dividends instead of the growth of my portfolio. We focused on the dividends here, and then, down the line, 3 months, 6 months, year, 2 years, we will see that growth, obviously, from the stocks, but we got to wait to see that, right? And if we do have a downward market, instead of getting stressed out or worried about that, at least we know that we're paying off our interest, right? And our account's growing. So that's really what it is. Lots of psychological benefits there, but mathematically it is helping too, right? Again, lots of different ways to do this, but this is just my approach. So VFE, VDY, XEI, taking out the bulk of the portfolio, and then we have our covered call ETFs. Now, obviously, our covered call ETFs, our allocations aren't 100% right. We can see HDIV is about 15% here. That's more or less the same, but some of our other ones, like CDAY is a little bit high. This is supposed to be closer to 5%. SDAY is supposed to be 5%, and HHIS is supposed to be 5%. So we're a little bit not allocated 100% correctly, and most of it is because in the beginning I had less funds. I was just spending too much money on each individual fund. So I've kind of scaled that back, and the covered call ETFs, because they're very volatile, especially the ones like HHIS, we can see here that today it's down -2%. And this is the risks with some of the more higher yield covered call ETFs. And this is the main reason why I chose to make 70% of the portfolio in growth, 15% in a more conservative, stable covered call ETF like HDIV. The more aggressive ones, the more volatile ones like CDAY, SDAY, and HHIS, which I have noticed to be the case. These ones, they're such a small percentage of the portfolio that we don't have to worry about it. Like if HHIS goes down -2% for the day, it's not really affecting the whole portfolio as a whole. In fact, maybe these other funds, I've seen days where HHIS is down, but everything else is in the green, and we're actually sitting at a net return. And same with some of the other funds. So the idea here is that we can take advantage of this volatility to actually, I could buy the shares, and I've been doing that. So, naturally, the balancing kind of comes off, but a little bit. But when HHIS grows back up and we get some capital growth, I can trim it if I want. And that's kind of what we've been doing. But what I've been doing with the covered call ETFs, instead of buying like $100 or $200 when the big ETFs like VFE goes down, like VFE is down 1% today, so I might buy like $100-$200 worth of it. If HHAS is down like 2%, I might just buy like $50. So I've just kind of been slowing down the buys on them, and then naturally these ETFs, as I buy more and I use up more margin, it'll rebalance that way too. So that's one of the things we're doing. But again, the idea here, guys, is that we can use the volatility of these covered call ETFs to get higher yield of cost, get some capital growth, and also pay off the dividends. So we're kind of combining everything together. And in the next video, I'm going to talk about the role of the growth ETFs basically, and how they're all working together to kind of get the return in the short term, but also in the long term. And really at the end of the day, this is just making this whole margin thing safer. It's making it conservative. We're still getting like good results, right? We've seen some results. We've already made about $400 from the portfolio. Pretty good results in 2 months of investing. And we're able to make it sustainable, which is one of the biggest things. So again, that's the main focus here. Before we end today's video, I'm going to do a quick little update on the dividends versus interest, so you guys can actually see in real time how we're using the covered call ETFs to help bump up our yield and actually beating the interest. All right, so really quickly here, this is the spreadsheet. It basically tracks the monthly interest as well as dividends. This is the motivational tool. This is the psychological benefit of seeing even just our dividends outpace our margin account. Again, this is what I use with my other investments. It's just with the margin account, we focus it to the interest versus the dividends. So some of these values I didn't update them 100%. So this TFSA value you can ignore. It's actually a little bit higher. The yield and yield of cost is not accurate either, so you can ignore that. I didn't update that yet. Same with the margin used, might be a little bit off. I kind of update it every couple days or once a week or so whenever I have time. But what I did update was the realized return and the total gains, right? So we can see here, September, our first month investing with our margin account, we paid $2.65 in interest, and then we made $8 in interest. Made $5 in profit. October, we made $11.50 in interest, or we paid $11.50 in interest, and then the dividends made $32. $20 in profit. November, we paid $21.51 in interest, and right now we're currently sitting at $42 in interest. We still have 2 payments from S-Day and C-Day, as well as the payment from XEI. So I reckon maybe we'll be around $50 to $60 in dividends at the end of the month. So maybe we'll be at $31 to $40 in profit. So we can see over time, as we borrow more money, the interest goes up a little bit, but our dividends are also increasing as well. Remember, whenever we get the dividends, whenever you get dividends on Wealthsimple, it will go towards reducing that loan. So if I got a $10 dividend, all of a sudden my margin used will go down by $10. So, because margin interest is calculated every day, that day going forward, you'll pay a little bit of interest. You'll pay a little bit less interest. So that spread between your dividends and interest over time should theoretically grow and increase. So you'll have more dividends, you have less interest, and it'll be increasing. So that's basically one of the cool ways we use our yield to beat the interest, like we talked about in the last video. And one of the big ways we allow us to do that is by using the covered call ETFs. But we're not all in just on yield. We also will get capital growth. We can sell stocks. As you guys can see here, we got $225 in realized return. So this is stock sales. So by using the covered call ETFs, we allow ourselves to use more growth-oriented strategies as well to get more capital gain, because I can hold more VFE, I can hold more VDY if I want. Meanwhile, if I was trying to hit that yield, which is dividend stocks, I'd have to cut back on VFE. I'd have to probably cut back on maybe VDY and go for more higher dividend yield stocks, which might not get as much capital growth, right? If I was going after maybe some of those utility companies or something. So again, the flexibility that we get by using the covered call ETFs allows us to get more yield, but also allows us to actually invest more in VFE and some of these growth-oriented funds as well to get a nice good balance. So if I was to summarize everything of why we're using the covered call ETFs, that's basically why we use them, as well as to help the portfolio be more balanced, right? Because everything kind of works together. So hopefully you guys, these videos are helping you guys. Hope you guys are understanding them. I know there's a lot to talk about and there's a lot of different things, and there's a lot of overlap with the different videos I've done, but hopefully this margin investing case series will help kind of put the pieces together, because there is a lot here to uncover. And especially if you guys, I know a lot of my audience is more beginner focused, it can help you guys to kind of go over this stuff, multiple times per video, revisit it, and that's how things stick, right? So that's the whole idea here. And again, like I said, in the next video, we'll talk about the growth aspect of things and why we're using the growth funds and what's the purpose of them. Like how is that going to benefit our margin account? But that's for the next video for you guys to see. Anyways, if you guys enjoyed the video, let me know what you guys think. If you guys have any questions, let me know what you think. And last but not least, I do want to address one thing. I've had a few people talk, mention on Blossom and stuff like that about risk tolerances. And risk tolerances really come down to what you guys want to invest into. If you guys want to take on more margin, or if you guys want to take on more debt, that's up to you guys. Obviously, you can get more gains, but the opposite can happen too. And it comes down to everybody's personal risk tolerance. I picked a conservative approach because I know most likely I'm probably going to go over those numbers, just because that's how I am. So our goal is 7% under current market conditions. If things drop, you might bump it up to 10. Maybe we'll go a little bit higher. I don't know. We'll kind of see how things go. But once again, we're getting our feet wet here. We're just starting out. I think one of the worst things you can do is just get started with margin investing, and then you blow like 20% of your margin in day one. I don't think that's probably for most people, unless you're already really experienced, probably not the smartest thing to do. And getting out of that can be a little bit tricky, right? Because it kind of locks you in unless you want to take a loss. So, again, I just want to kind of like let you guys know that you can alter this. You don't have to do it the way I'm doing it. You can adjust your risk tolerances. You can add more growth. You can add more yield. You can go more covered call, whatever you guys want to do. Just understand the pros and cons of whatever approach you're doing and have at least some type of balance. I would encourage you guys, and also, take things slow. That's probably the most important thing. But anyways, guys, let me know what you guys think of this video. So far, the margin account has been doing really good and kind of like wonky market conditions. Obviously, we've been up and down, but we've been doing really well. And the real test, of course, is going to be when markets do drop, but we don't know when that's going to happen. We're just going to keep at it, keep taking advantage of things, and keep working hard. So, anyways, let me know what you guys think. Take care. Have yourself a good one, and I'll see you guys later.